Okay, given Bill is actually leaving at 3:30, I'll condense my session a little bit and give you a really quick overview of partial budgeting, if you like. Just a couple of really simple tools to get you thinking about how will you handle this mixed farming concept, possibly giving you some ideas on how you might analyse the different opportunities you have, and then how do you take that into account when you're looking at managing risk. So the first thing to realise is that partial budgeting really is just a means of marginal analysis. So we're potentially comparing multiple things. In the first part, we might be just looking at different input levels of a fertiliser input, for example. So are we better off increasing our fertiliser input, reducing our fertiliser input? How do you make that decision? We can use the classic back-of-the-envelope technique, partial budgeting, and that's basically what it is. Another thing we can start to look at is when we start swapping inputs around. For example, swapping labour and machinery. That was a pretty hot topic today. A lot of people were thinking about it. How do we analyse that? How do we put it through the system so we can actually make an informed decision? It may not be the correct decision, but at least it'll be a good, well-based, objective decision. And that's the critical point. The third one may be actually swapping enterprises around. A little bit more of this and a little bit less of that. So how do you come up with those solutions for those things? This is the basic structure. This is not rocket science, but when you do these sort of back-of-the-envelope techniques, or mind you, it's a hell of a lot easier on a spreadsheet, and I agree with Bill, spreadsheets are the best thing since the wheel. But we're just economists, so we live on these things. But we've got to take both sides into account. So when we're looking at the costs of the change, we're actually looking at the additional costs and reduced revenue. You've got to look at both sides. What are you losing if you make the change? And also, what additional costs will you incur when you make the change? So you take those things into account. On the other side, we want to look at the benefits of the change. So what's our extra revenue? Well, that's a no-brainer. Obviously, you take that into account as soon as you do any sort of analysis. But the other critical thing is, what are our reduced costs? That's a benefit as well. So are we saving something from making this change? And if we take both into account, it allows us to come up with some total costs and our total benefits, and our net profit of the change is the difference between those two. Pretty logical. If you're wanting to know whether or not it's a good investment, then you look at the return, that net change in profit, or the difference between the benefits and costs, over the amount of extra capital that you're putting into the system. And it's a bit like a return on assets. What extra return are you getting for the assets you're putting in to the change? And so it's a really simple concept. So what we've actually got in the papers that you've all been given is a case study example. So if you all switch to page 21 of the document in front of you, and you read a little bit of a blurb at the front, so you've got a bit of a handle on what the business looks like, and this is a nice little exercise. So, for some of you, you'll be getting flashbacks to your first or second year of university or TAFE or something, and hopefully it won't be too scary for you. But this is a really nice little case study. So just read the first couple of paragraphs on page 21 and then make your way to the bottom of page 22. And I'll just give you a moment to quickly skim over that. How many people have got to page 22? Anyone? Has anyone not got a copy? Otherwise, Tony can drop you one very quickly. Which page am I looking at, Ted? Page 21. Oh yeah, that's supposed to be 675,000, Ted. Thank you. So that's the expected total gross margin for the property, following on from what Bill was describing before. So once you get to that mistake, flick to page 22, please. and there's a puzzle to solve, and the question is, there's an alternative farm plan to the one that's described on page 21, and that's where we reduce the size of the crop and we allocate more land to livestock. So how do you make this decision? What do you take into account? For starters, obviously the crop area is going to be reduced down to 1,800 hectares in this particular case, and a new enterprise is going to be introduced. It's 700 hectares allocated towards a merino crossbred lamb type operation. So the question is this actually a worthwhile thing to keep investigating? You know, this is just a typical back of the envelope calculation. Should I make that change in the first place? Is there a positive margin in it? How much of a margin in it? Should I invest more time and effort into analysing this in much greater detail? And so this is your first step. And so the challenge for you is I want to know, and I'd like you all to work as groups on tables, or work within your tables, look at the information that's on page 22 and 23, and tell me what the rate of return or what the return on extra capital invested may be. Even if you just come up with the net profit of the change, that'd be really good. And the first table to come up the front with an answer will get a prize. So go for it. You've got to look for those extra benefits in that scenario. Where are the gains coming from? What are the extra net benefits? Has anyone made any progress? Because we've got one table down the front here that's figured it out. Is there anyone else? The terminal production data. So, look, we'll just run through the exercise. It's meant to be fairly simple, and all the information that you required was on that front page. So, the first thing we're looking for is the extra benefits. And so, what's the annual gain? What's the extra annual gain? The gross margin from the livestock we're running. Because remember, we're substituting 700 hectares of crop for 700 hectares of livestock. And the livestock enterprise is this terminal operation. We've got to buy and use, obviously. We've got to sow some pasture, obviously. But what's the extra revenue? What's the benefit from the change? The benefit side is we actually get a gross margin from these sheep. And so $25 per DSE times 12 DSE per hectare over 700 hectares. Pretty simple mathematics. It's $210,000 extra income that we're going to generate. So that gives us a total benefit of 210. You know, we could include other things in there if you could value them, basically. So there might be some of these complementarity issues with terms of the rotation. On the extra cost side, what are our extra costs? Well, we actually lose crop revenue, or we lose our crop gross margin on 700 hectares. We also have the extra amortised or depreciation cost of the pastures that we need to sow, and we also have the depreciation on the extra infrastructure that was required to run the sheep. And so when we add those three things up, we've got 700 hectare reduction in crop gross margin at $150 per hectare. So in other words, you're identifying the worst of the cropping country and saying we'll allocate that to the merino enterprise. And so we lose $105,000. We have pasture depreciation costs just roughly nutted out at about $11,000. And we have livestock infrastructure, so another set of yards or whatever it may be, at $2,500 per annum effective cost. That gives us a total of $118,000 in extra costs. And that's included both foregone revenue plus actually extra costs of making the change. So what's our difference? Our difference is $91,300. That's good. So it's positive, but how much positive for how much money we're committing to the project, or how much money for committing to the change is the question. Well, if we look at how much extra capital is tied up in this change, we're putting 700 hectares times 12 DSC times $80 a DSC. We're putting $672,000 into livestock. That's pretty significant. That's a lot of capital going in there. We've got $50,000 worth of extra infrastructure. And we've got $168,000 worth of pasture going in to make the change. In total, that gives us a 10.2% return on our extra capital invested. So, is that good? This will show everyone's aversion to risk. Is that a good return on capital? For some, yes. For some, no. It depends. So it probably warrants a little bit further investigation. Yes, Ben. And so what would be your next step?
Then factor in the second year of loss from the crop. If you factor in your second year of crop that you're actually giving up to establish your pasture, all of a sudden it's going to come back a lot closer to square for that initial part, and then maybe you're in front year after on that.
Yep, absolutely. And the only way you're going to discover that is by starting a development cash flow budget. So in other words, you're actually doing everything and you're putting it through your normal budgets, which hopefully you're doing anyway, on an annual basis, and you put it through that and you look at it over 3 or 4 years or 5 years. We do much more complex things than that using net present value and internal rate of return, where we look at possibly investments over 10, 20, 30 years, depending on the change of the strategy that's involved. For example, if you're looking at agroforestry, there would be not much point looking at using a partial budget to analyse that, because what's the steady state of agroforestry? You harvest it after 30 or 40 years versus the livestock enterprise that's running every year. So it doesn't work. And that's when you have to move to even further different techniques that help you analyse investments like that. So it's a first look. It's a quick and dirty. It's looking for the marginal changes in your production systems and whether or not a small change can actually make a difference to your bottom line, and whether or not it pays. So this is a good place to start. I call this the typical back of the envelope method. And back of the envelope's really good. You just got to do it the right way and take everything into account as a first look. So once we've done something like that, we can add some sensitivity to it. We can actually run a series of what-if questions. What if the price is not as good as what we thought it was going to be? What if the yields aren't as good as what we thought they were going to be? That's basically what a sensitivity analysis is all about. A sensitivity analysis can be built into not only gross margins, it can be built into a whole farm plan, it can be definitely built into a partial budget. So what sort of things do you have to take into account? How do you handle a series of price sequences like this? How do you take that into account in your planning? Do you just go on what the current price is now and you say, well, look, I think that's pretty well what it's going to be for the next 12 to 18 months? Or do you start looking at trends? Or do you take into account a bigger array of potential prices that you might be exposed to? And as soon as you start doing those what ifs, that's just what sensitivity analysis is. There's nothing overly complex to it. And so if I look at those prices and I can generate something, a percentile table basically, which shows me the distribution of those prices and also gives me an indication. What you might have noticed here, I've whacked in some long-term wheat yield data as well, because I just want to get a handle on, what sort of variation might we see. And so at 0, which is the lowest we ever recorded, it was 0.3 tonnes per hectare. So this is Wagga wheat yield data generated from 1880 to 2011 using rainfall data, of course, so it's a bit simulated. But just to give you a bit of an idea of what sort of variation that you might be exposed to and how you might sort of use this sort of information and a risk profile of a particular enterprise. The prices, for example, range between $131 per tonne and $353. The median is 182, 50th percentile. That's the median, this one in here, $182 per hectare. Our median yield is 3.9 tonnes per hectare. And so when you start looking at that distribution, what do you notice? What do you notice? Does anyone pick anything up? One, there is a massive variation between the minimum and maximum, but have a look how much variation there is in the middle there. It's only a couple of tonnes, but it actually captures a lot of the price, a lot of the yield information, and a lot of the price information. So it's a bit tight in the middle. So it's your typical bell-shaped curve, I suppose, is what you're looking at there. It'll become more apparent in a minute. So I'll look at these percentile prices just to give me an idea of what's sensible prices and sensible yields to use in a sensitivity analysis. If I put all that into a spreadsheet, don't do this on a piece of paper because it'll take you a long time, and we actually look at gross margin per hectare. So this is net of variable costs, so this is your typical enterprise gross margin. And we've got our percentiles all the way across here at the top for grain prices and our percentiles here for yields and all our different levels. So it reflects what the existing population is. Now, for us to use this for any sort of planning purpose, we're basically assuming this historical data is what we think is a good expectation for the future. That could well be wrong when you look at this graph. You might say, look, that price series is way too long. I shouldn't be considering prices pre-2006 because the world's changed. And so you may not go back any further. And so at the moment I'm using the whole lot just for the point of the exercise, just to give you a demonstration. But what makes good prices to use when you're trying to run a series of what-ifs? Do you use the very top price and say, yeah, I think that's, I'll look at that? Or do you use the very bottom price? And so they're things that you can take into account given your degree of risk aversion and confidence in the future likely outcomes of prices. And so if we look at this, $250 per hectare is our median gross margin, and from that, everything else spreads. You have a look at that. What sort of, where does it start to kick in where you make a loss per hectare? Now, this is just gross margin per hectare. This doesn't include overheads or anything like that. We're not allocating anything here artificially. So, you can see that across here where the numbers go from black to red, we're going from a profitable situation, or not in the short term anyway. In the very short term, we're going from a profitable situation to a loss situation. But you can see there that happens at a range of prices and a range of yields. So this sort of information very quickly allows you to get a very quick snapshot of the risk profile of that particular enterprise. And then you can make the decision whether or not you think that region, what's the probability of that region occurring in the future, if you're comparing this enterprise to another one, for example. So So if we look at the actual distribution of those gross margins, we come up with a histogram like that, and we can see that around that $250 per hectare mark gross margin, it's occurring 25% of the time. So this gives us an indicative risk profile for that particular enterprise. These gross margins you could certainly go and use in your whole farm plan then. And so it just builds into it. And that's the process you would go through. What you can build on top of that then is a break-even analysis where you either hold yield or you hold price constant, and you look at what the other one needs to be for you to break even. In other words, $0 profit. Now the thing is, I would put money on it nearly that none of you are managing to achieve break even. Oh, some of you might, I suppose, depending if you're starting from a low base, break even probably looks good. But most of you aren't. So it's, how useful it is somewhat limited. But if you work out a break even yield or a break even price, and then you go back to these sort of percentile information, you can get a bit of a gauge on what sort of probability there is of you actually achieving a price or a yield higher than where you're sitting, and how exposed to risk that you are. It's gone. So, do we have condos beaming in for anything, or no? Okay, so what I'd like you to do on your own, this is not at a table level, just write down on a piece of paper, out of all the things that you've heard today, you've heard quite a number of ideas from a lot of different speakers. I would like you to think about, any particular strategy that you think is best suited to your system. So this is for producers, for advisors, and anyone else who services agriculture. Think about a particular client and something you might approach them with. So what sort of strategy might you consider to change in your farming system, in your mixed farming system? Just write down one or two. Okay, so once you've jotted down just one or two ideas, the next thing I'd really like you to do is think about what do you need to take into account to make a decision on that potential strategy. What sort of things do you really need to take into account? So, what sort of information do you need? And where is it going to come from? Do you have it in place now? Can you extract it from your current systems? Great. So just jot down the different information sources that you'll need to analyse that strategy and put it in this structure. What are the extra benefits from what you're looking at doing? And then what are the extra costs from what you're looking at doing? You obviously don't need to come up with an answer, but once you've identified those, you can go back and start to put some numbers to what you're working out.